Hello and welcome to the Essential Property Podcast with your hosts, Paul Samuda and Amanda Woodward. With 45 years of combined experience in the world of property buying, selling, investing and developing, they are here to share with you their knowledge in the Stoke-on-Trent, Newcastle-under-Lyme and Crewe property market. Let's get started.
Hello and welcome to episode 24 of the Essential Property Podcast, where we talk about all things property related in Stoke, Newcastle-under-Lyme and Crewe. And today I have the pleasure of having Craig Adams from Signature Financial Services with us. And Craig is a sales director of a financial services company based in Staffordshire, who I have the pleasure of speaking to all things financial, mortgages, bridging and everything else along the way that an investor needs when buying property in the area. So I'm going to pass you over to Craig for an intro about who he is and the company, and then we're going to work through where we stand in terms of the current market with regards to mortgages and finance, and work through a whole bunch of other questions along the way. So welcome to the podcast, Craig.
Hello, Amanda. So as Amanda says, I'm Craig, one of the directors here at Signature Financial Services. We are a mortgage brokers, but we're probably not a traditional mortgage broker. So we like to say if there's a property, then we can finance it in some way, shape or form. So that means we can do your standard residential mortgages, but we do a lot of specialist buy-to-let business, HMO business, your limited company. We have lots of portfolio landlords. So yeah, if it's property related, we can fund it. Signature Financial Services was founded in 2009 by the managing director, Dean Birks. I joined the company in 2017 and climbed up the ranks. And like I say, now we sort of run the business together.
Good stuff. And I remember meeting Dean really, really early on when I first started investing in Stoke at one of the PIN meetings. And he was there talking about the company and so on. And the company has grown dramatically over the last few years. It's been wonderful to watch. And I know you guys do some great stuff for investors. So, I mean, the market is ever changing and there's obviously a lot happening at the moment economically as well. So it would be really good if you could give our listeners sort of a snapshot as to where we stand today in terms of sort of the mortgage/financial market.
Okay, so I mean, today is the Bank of England monetary policy meeting, of course, and it's widely expected that interest rates are going to go up again by 0.25%. So the Bank of England base rate will probably rise to 1%, which is the highest it's been for a good while, and it's consecutively rising. Now, for what we do, it means people are fixing the mortgages for longer. People are worried about interest rates going up. Inflation's at 7%, which is why the base rate is going up month after month, because they're trying to sort of bring that down. I mean, this is sort of all doom and gloom, but there is probably some good news as well. So your residential mortgages, the residential lenders are quick to sort of react to interest rate rises. So their margins aren't as high. They try and keep the rates as low as possible. It's very competitive. Big banks and building societies competing for residential business. Personal name buy-to-lets does tend to follow the same pattern, but your specialist buy-to-lets, your HMO buy-to-lets, your limited company buy-to-lets, the lenders like sort of Precise, Kent Reliance, Paragon, etc., because their rates have been historically so much higher anyway, we're kind of seeing that gap close rather than, you're coming to me for your HMO mortgage and me going, well, since last time the base rate's gone up by 0.9. I'm actually seeing that they aren't rising as fast as normal mortgages, if that makes sense. So we've had a free cut. By the end of today, we will have rose from 0.1 to 1%, and specialist mortgages haven't rose by 0.9%. So a little bit of good news. From our perspective, from a business perspective, we're encouraging all our clients to make sure they're reviewing the mortgages, make sure they're fixing the mortgages. And I think it's widely expected that interest rates are going to continue to rise slowly. No one knows for sure. It's a crystal ball. I believe, and this is just an opinion, I think we'll have two or three interest rate rises per year now moving forward. So it's more important than ever that you're reviewing your mortgage, reviewing your portfolio, and trying to sort of make savings where you can.
Yeah, I would agree. And there is a lot of talk about perhaps ending the new year around about the 2% mark interest rate wise. And we're reviewing our portfolio and we've got a bunch of product changes going through and even some switch of lenders as well to try to, plan as best we can for the next few years going forward. I'd like to talk a little bit about green mortgages.
Yeah.
Something that I don't know a huge deal about, but I know that more and more people are taking advantage of those that are applicable for it. So I thought we could just expand on that a little bit with our listeners and just explain, what they are, the benefits to investors, and if they're particularly popular and are going to be with us to stay for a while.
Yeah, this is a massive change in the market. I guess it's the equivalent of the electric car in the housing market. So a green mortgage isn't as complicated as it sounds at the moment. It's EPC rating, so your energy performance certificate between A and C. Now, what lots of lenders are doing is giving better products for those properties. They're actually chasing that business. So, you'll get a better rate for buying a new build than you will for buying an older house at the moment. And the buy-to-let lenders are going the same way. We are seeing a few lenders that are dipping the toe, and this is very early stage, in sort of green further advances. I think this will be a big thing in the market over the next few years, a big thing for brokers, a big thing for landlords. We're probably all aware, if you're a landlord, of the EPC changes that the government want to implement by 2025. So if you're not there, what that means is the government wants all newly tenanted properties to be EPC rated between A and C by 2025, existing tenancies by 2028. I'm digressing a little bit, so I do apologise, but I don't think that's possible, to be honest. I think there'll be something that comes in place, which is perhaps, a D plus or something. I think the government will have to rethink that. There's, I pulled up a stat, 36% of houses from the UK were built before 1940, and certainly, a lot of Victorian houses and stuff like that. I don't see how you can ever get them to a C. So I think the government will do something, but I think they'll concede on that a little bit. As it stands, though, because we are talking about green mortgages, if your property is an F, it's unmortgageable. So if the government stick to that, if your property was a D, it would be unmortgageable. So it is something we've got to think about. Like I say, personal opinion, I think they'll do some sort of hybrid and they'll make you do something. Now, the further advance with lenders will be to raise money at a competitive rate to do these work. So I imagine they'll want invoices and things like that. So you can go back to your current lender and say, look, I'm going to make my property between A and C, but I need 15,000 to do it, to change the boiler, to change the windows, etc. Can we raise the money? And I think we're starting to see that coming to the market. And as I say, from my perspective as a broker, be massive in the coming years. We can't ignore green mortgages and we can't ignore the energy efficiency that the government are going to put in place. I'm just not sure it's going to be as strict as they want. I don't think the targets are achievable, but I think there'll be something. Was that too much?
Brilliant. That's brilliant. I had no idea about the further advance. That's really good for our listeners, which naturally some landlords are going to have to take advantage of, to be able to do that. I mean, we've got some properties that have got, new combi boilers, central heating, et cetera, et cetera. And I'm pretty sure they're still like around about a D. So we need to definitely have a look and see, what are those requirements to push them up to the C. What sort of reduction in interest rate, or what is the term? How more beneficial are the terms?
Yeah, it's not amazing yet, to be honest with you, Amanda. But I guess it's relatively new. So some lenders are sort of 0.2% cheaper. So in terms of great, if your property's already A to C, you've got a saving. But in terms of spending 10,000 to make it a C to get a 0.02% saving, there's not much of an incentive there, is there, yet? But I think that'll continue to grow. Residential lenders sort of offering cashback and things like that for green mortgages because, the banks like to be ethical, don't they?
Sometimes.
Well, yeah, I did say that with a little smile myself, but yeah, so they will be looking into this more. They'll be over it to show that they can, work with the government on this. I think there's opportunities for all of us though with this. So some landlords will go, I've had enough of this, just like the tax changes. Like, some landlords will be like, enough's enough, and they'll be selling off stock. So, there's opportunities to perhaps buy portfolios, buy properties below market value. Bridging finance, you can use bridging finance to increase the EPC if necessary, if these properties aren't mortgageable. So yeah, there's opportunities for us in this industry. There's opportunities for letting agents to be educating their landlords as well, and opportunities for landlords to hopefully get some cheaper properties, because there will be a percentage of landlords will be like, enough's enough, just like when the tax changes came into play.
Yeah. Well, we'll see what the future holds with regards to that. And you mentioned about bridging. And I don't know how many of our listeners are using bridging for their property purchases or know about how it works. I know many, many years ago, bridging was a little bit of a dirty word. Mm-hmm. It was just associated with extortionate sort of fees, and it was hard, to make the deal work with bridging. But I know that's changed a lot. So perhaps you can give us a bit of a summary in terms of sort of the products that are on the market with regards to bridging finance.
Yeah, of course I can. So with bridging finance, you're right. It's still expensive, but it's short-term finance, And I'll often say, I know it sounds a bit salesy, I'll often say to a client, well, you pay for a taxi to get somewhere quicker, don't you? So bridging finance, you're probably looking at sort of interest rates. They've always quoted monthly between 0.5% up to 1%, depending on the deal, per month. So you're factoring that in. On average, a sort of a 75% light refurb bridge will be about 0.7 a month. You have your arrangement fee. It is quoted monthly, not just so it sounds nicer, because ultimately, if you're only on the bridge for 4 months, you don't pay any more interest. We generally set clients up on like a 12-month bridge, just to give them, if they're flipping a property or refinancing, just to give them enough time. But it works slightly different to a mortgage. So normally there are options to service it monthly, but in most cases, the majority of bridges we do, client will apply for a bridging loan. The lender will take the 2% arrangement fee and 12 monthly payments off the loan. So your 75% loan to value bridge really means you need a 30 to 35% deposit, but it's all costed out, So if your numbers work, then bridging finance is a brilliant solution. And I have lots of clients who build portfolios very quickly using bridging finance. And if I have a client that says, I'm going to bridge this, and work out the finance costs for them, and the project doesn't work, I'll say, Amanda, I don't think that quite works. I don't think you've got your numbers right. And you might go, no, I have, Craig, sod off. But ultimately, we're trying to look at it holistically for clients and saying how can you get out of this bridge? Are you refinancing? Because we don't want anyone to be stuck on a bridge. But yeah, it's a really good solution, bridging is. There's a few sort of bridge to let products, a few bridge refurb products as well, where you can sort of get higher loan to values and stuff like that. So there's a few bits and pieces flying off the shelf at the moment with bridging, to be honest, Amanda.
Good. So anyone who's out there listening at the minute that's thinking about doing a project that's unmortgageable, could be EPC related, could just be that there's, no kitchen, no bathroom, it's just a shell of a property, then ultimately they can look at, we've used the bridge to let type products, which we've used in the past, to then sort of move on to a more typical product. So that sounds good. Okay, you guys are based in Staffordshire. Last time I came to see Dean, you were in Newcastle-under-Lyme. I've got a feeling you've moved offices since. Is that right, or are you still there?
No, we've moved. As you said, sort of at the start of it, as you said in the intro, we've grown an awful lot. So we've had to find somewhere a bit bigger. So we're not too far away, but we're up the road. We're actually we're on Lymedale Business Park, which is actually classed as Chesterton. So it's still kind of Newcastle-under-Lyme. We're about 2 miles away from where we were before.
Okay, good stuff. So in terms of your client base, so do you work with mainly local investors? Do you work with people nationwide? What's your kind of client base like?
I'd say probably 50-50 now. We have a much further reach than we ever had. And I think COVID has changed that for everybody, to be honest. So yeah, we still love to be classed as a local firm, and we still look after our local people and stuff like that. But yeah, the other sort of 50% of the clients we've got are all over. And, we don't do as many face-to-face appointments as we used to, for sure. Things like what we're doing now, talking and podcasts and Zoom and stuff like that. And COVID changed all that. So yeah, we're doing clients all over, quite a few clients in Derbyshire, quite a few London clients. I know some of the team are doing Durham and stuff like that. So yeah, it doesn't matter as much anymore. You haven't got to come see someone anymore, have you? You can Zoom and stuff like that. And even if some people go, well, I prefer face-to-face advice, most people are still happy with a Zoom as a face-to-face advice, aren't they, nowadays?
They are indeed. And then just in terms of network, we work with a lot of international investors, and the international appetite for investing in Stoke and Crewe has also grown dramatically over the last few years, where investors are chasing yield effectively, and they can't get that in London, and they're looking further afield. And Stoke has always been a good patch for international investors, who largely buy cash and who largely keep their assets unmortgaged, mortgage free, because mortgage rates have been so incredibly high, sort of 7 or 8% for them. I know it's not your core area of focus, but in terms of any international investors that are listening, is there anything that's making it a little bit easier for them to raise finance now in the UK, and what type of rates?
So we're doing a lot of joint venture limited companies, to be honest, for international investors. So, and it doesn't work for everyone. I know it doesn't, but if we have a limited company buy to let and the international investor is 19%, so in other words, below 20%, then they aren't assessed on the application. They can add deposit, they can add their value of whatever they're doing with any other joint venture. And yes, some lenders don't do it, but it opens up the specialist buy-to-let market for them. So your rates are between 3 and 4% instead of sort of 6 and 7%. So that's how we're doing international investors limited company buy-to-lets, with joint venturing with sort of someone from the UK. Now, I know that's not always possible. I get that. So the sort of full international investor, if you like, are still paying a premium, to be honest. So lenders are concerned and solicitors are concerned. It's money laundering ultimately. And I'm not suggesting for a second that anyone you work with is even trying that, but that's the concern. It's sort of, that's why it's a premium, and that's why HSBC aren't doing it. And it's much more difficult than your UK national.
Yeah, we've got some investors that we work with on a JV basis, and that is the huge benefit, is the ability to raise finance. And I think we are lucky as investors in the UK that we do have the ability to raise, enormous amounts of finance with local banks at what is still pretty low interest rates. 3 and 4%, it's still pretty low.
Yeah, definitely.
So we definitely have to be grateful for that. In terms of new products, I know the market is changing all the time for UK-based investors who are operating in the property investment space. Anything new that we can share with the listeners that's worth hearing about, on new products or new terms?
Yes, there's quite a few new products for investors. We mentioned green mortgages, which is coming for everybody. There, as I say, it's not sort of rushed to the banks, and they're not quite there yet, but that's going to be big. We touched on earlier about sort of the bridge to let. Now, the bridge to let has been around for quite a while, but it sort of was pulled during COVID, and now it's back again. It's back to where it was. The loan to values were restricted. So some of you may know about it, but the bridge to let product it's a cracking product. So it's a 6-month bridge with a mortgage offer day one. So 75% loan to value bridge, you can actually exit to 80% if you want. But how that works is you send, and it's precise mortgages that do that, who are pretty competitive for limited company mortgages. So it works well. It's for your life refurb, your kitchen, your bathroom, your liquor paint, nothing, no extensions or anything. But you go in, you buy the property, buy it below market value, you produce a schedule of works. I'm going to do this, and this. This is why it'll increase the value. The valuer goes out day one and says, yeah, you're pitching it for 100,000. That's fine. Yes, it'll be worth 150. That's fine. So you get your bridge terms and your mortgage offer day one, and that gives clients a lot of comfort to know that their exit's already in place. There's a re-inspection, so the valuer just goes back out and says, yeah, you've done what you said, and then that's it. So you sort of pay the bridge off with the same lender, and that's a quick way of sort of buying a property, doing it up, and getting your money back out straight away. So lots of people like that. They like that. Shawbrook have what's called a refurb bridge. And Shawbrook are doing, you have to be you have to have properties in the background basically with Shawbrook. But they're doing an 85% loan to value bridge if you want to do a refurb. So again, that works on the basis of you buy a property and you have an extra 10% for refurb. So you buy a property, you produce a schedule of works, and they'll just give you 85% day one. That one's absolutely fine, because it means here's your money, crack on with it. They don't check what you're doing with the money, and you can exit with anyone. So it's just giving you a higher loan to value on your initial bridge. The rate on that is 0.85 per month, though, so slightly higher than a 75% bridge, but people are all over that one at the moment. And then your portfolio lens as well. So I don't know if any of you sort of have portfolio lens, or if you do individual mortgages across your portfolio and stuff like that. I know there's a combination of what people do at my clients, but Aldermore have a multi-product. So if you're doing quite a few properties at the same time, or remortgaging, or if you're going for 6 properties on one day for your sort of multiple dwelling relief and stuff like that, I know lots of clients do that, then they have one loan across however many properties you want, but with free legals. So, if you've got 10 properties, that's massive, isn't it? Free valuation, massive. And you can actually do that in personal name or limited company, to be honest. But you're just having one loan across the whole lot. The rates are competitive. And obviously with the free valuation and free legals, that one's working really well at the moment. Portfolio landlords too.
That's great. I mean, and is that them just trying to win sort of bulk business effectively? They want to win the 6 properties.
I mean, why wouldn't you really? I mean, let's be honest there. You guys and the people you work with and people I work with are brilliant customers for them, aren't they? The good tenants, pay mortgages, good established portfolios. So I think it's really, really clever for them to go, let's pinch some really good portfolio landlords. So yeah, I think they're just aggressively targeting successful landlords.
Yeah, no, that's great. And that's great detail there, Craig, because the market is moving, really quickly. And so to be able to keep our listeners up to date with some of those products, I really appreciate that. So thank you for that.
No, you're welcome.
Just in closing of our episode today, do you have any examples? I'm going to put you on the spot a little bit, but do you have any examples of clients that you've been working with that have been doing projects locally that you could share in terms of how you've helped them on the finance side?
Yeah, so I mean, again, so looking at Newcastle under Lyme, I've got a client that's been doing sort of many HMOs, doing 4-bed HMOs close to Newcastle in itself, for those of you that don't know, is quite close to Keele University. So lots of students. You've got Newcastle College and stuff like that as well. So yeah, it's in an area that's sort of between the college. It's very close to the college actually, but between the college and close to the university. And yeah, so I've got a client that's he's bought 3 houses in the same street now, and it's just been so successful for him. I can give you the numbers as well. So we're taking 2-bed terraced houses. I don't get my hands dirty. Sorry, that's me claiming to. But yeah, he's taking 2-bed terraced houses, turning them into 4-bed HMOs. So purchase price is around 125,000. His refurb cost is around 25k. This is varied between all 3 of them, actually, so I'm giving you the average. And then the refinance, we've just done one of the 3 refinances, 2 to go. So we refinanced that at 180,000, and we did that 75%. We could have done 80%. So he's getting 135k back on that, which means obviously he's got his initial money back, plus a little bit of the refurb. So he's leaving a little bit of money in the deal. I get that. Some of you might be like, oh, that's not quite enough for me. But I think personally, I quite like the thought of that. If I could get a fully refurbed, let out house and just leave sort of 10% in the deal, I'd be happy. The ones where you get all your money back out and make money tend to be few and far between, don't they, these days? I don't know if you're finding that, Amanda.
Yeah, that was sort of our model probably 10 years ago. Mm-hmm. To buy something at, probably 40 or 50,000 and spend 10 and it get valued at 80 or 90. But those days, unfortunately, have passed. But no, those numbers sound great. You leave about 2025 in, and I'm assuming some great cash flow.
Yeah. So they are. I think it's £500 per room. So I'll say, but we still got two on the desk at the moment. Well, the bridges have completely series refurbing and we've just refinanced one. As I said, I do quite a lot in Derby as well. So you've got, those valuations are bricks and mortar valuation because it's a 4-bed HMO. But there are a few lenders now that, so HMO wise, from my point, and I never get through a podcast or a video without talking about valuations. You can't not, can you? If there was a chat box, someone would go, can we have a commercial valuation? I'm sure they would, Amanda. But yeah, so we've got a few lenders doing sort of hybrid valuations on 5 and 6 bed HMOs. So 4 beds and below, bricks and mortar. 5 and 6, then you've got sort of your commercial hybrid valuation, 7-bed plus commercial valuation. So one in Derby, there was a client purchase for 148,000 and it was a 5-bed, and we worked on the hybrid valuation of that. His refurb was 36,000 and we refinanced that at 250,000 based on rental income, So that's working quite well. Some of these hybrid valuations are to sort of understand what that means is the valuer almost has quite a lot of say on them. So Shawbrook do them and Lambay have started doing them. So the valuer will go out, it's a well-established HMO, it's in an Article 4 area, yes, I'll give it a commercial val. Or they'll go, yeah, sort of commercial, well, not 10% off. And it's kind of, so it's managing clients' expectations, but they have gone well and they have been higher than bricks and mortar. What the lender's looking at, and it does kind of make sense, if you've got a 5-bed HMO with 1 bathroom, that's still a house, isn't it? So to ask for a commercial valuation on something that if they had to take it, then that's difficult, isn't it? Because they're going to sell it as a house. If it's a 5-6 bed HMO, all en-suited, your fire doors, all that sort of thing, and it's a HMO. If they had to repossess that, they could sell it as a HMO, couldn't they? So that's where that's their sort of theory behind it. So yeah, so that was one in Derby that went really well, and I'm just doing a really big deal with 14 flats on one title. And he's actually mortgaging that. He's mortgaging it for 2 years because there's tenants. There's 10 tenants in, 4 not, and he's going to sort of refurb it on a rolling basis and move one tenant to another flat and stuff like that if the tenants are happy to do it. So he's hoping in 2 years' time that it's worth a lot more and we'll refinance it.
That's good stuff. So I've got 2 questions on the back of that. And like you say, we can never have a discussion about talking about HMOs. I think most people are under the impression that, yes, we get that small HMOs are bricks and mortar. The 5 and 6 bedroom market is subjective to the valuer's comments. And we've had both full commercial valuations on 5-bed licensed properties. And we've had, I can't mention any names here or any valuation agencies, but I think you know exactly who I'm talking about. One particular gentleman in Stoke-on-Trent who values every HMO at 0. There's a real mix, which is fine. I think what's hard for the investor is how can we plan for that in advance? When we say, hi, Craig, I've got this great 5-bed HMO in Stoke, fully licensed, I want to take some lending on it, but I'm looking for that sort of slightly bumper valuation, not ridiculous because we don't want to overborrow, but I do want to get that, yield-based valuation. And you say, okay, we've got these lenders that we're open to. How can we start to pinpoint them? I think this one will give it, I think this one won't, if it's down to the valuer. Do you have that sort of intelligence in advance?
No, I mean, I really don't. And you know what valuers are like, and there can be no pattern to them. But, I'm not going to sit on the fence entirely. So based on sort of past applications and past information, I always sort of say, well, what I said earlier, so, established HMO licensed, in an Article 4 area as well is better because, in an Article 4 area is better. That will most likely get a HMO valuation, a commercial valuation without any issues. So clients go from bridge to 5-bed HMO. They've got a license, fine. They've got no tenants in because they want to refinance it so quickly to get off the bridge. That's not going to get a commercial valuation because, it's a newly established HMO and it's very difficult, even from a valuer's perspective. I'll stick up for them, not very often. But at that point, it's difficult for them to know entity. So that's harder than your established HMO. And as I said, if you think of the property itself, some clients will go, well, I've got a 4-bed HMO, can I have a commercial value? No. If you've got all your en-suites, if it's a commercial property, i.e. a HMO, proper established en-suited HMO and stuff like that, you've got more chance of getting a commercial value than if it's a house share.
Yeah.
In terms of numbers, which I think is probably what you're asking me, I would say, I always tell clients to sort of work around about 8.5 times gross rent. So regardless of yields, work around about sort of 8.5 times. We tend to put them in at 10 times gross rent and then see what happens. But on average, and I've heard, and obviously no doubt you have as well, lots of people who go on the property courses and stuff, and they'll say you can get 12 times gross rent. And I've never seen it, never seen 12 times gross rent. I have seen sort of 10, 9 and stuff, but yeah, I tend to say be conservative, but 8.5 times gross rent could, be massive, couldn't it, as well?
It is. And we always have to be careful in terms of over borrowing, because obviously the more we borrow, the lower the cash flow on the property. So it's just finding that nice balance. But to know that you can have the ability to raise a little bit more finance does allow you to then bring the property a higher spec and produce a better product for the market. So that's all good. So that's my first question. My second question is, you mentioned about a gentleman who's got 14 flats on one title. If somebody is doing a flat development, either converting it themselves or buying something existing, I know the products vary dependent on size of the development, but what sort of products are out there for flats?
So, as in multi-unit freeholds, Amanda, there's loads now. So multi-unit freeholds up to 10, you can have specialist buy-to-let on that without any issues, and even 20 bed HMOs now. So so you're looking at your limited company rates, nothing scary. You'll probably pay 0.25% more than a normal single limited company buy-to-let. So the HMO multi-units sit in the same place in terms of products with lenders. That particular one is a bit too big for your specialist buy-to-let. So up to 10 multi-unit freeholds, away you go. And you're going to pay, as we talked, sort of, if you're doing a 5-year fix, which we're doing a lot of at the moment, probably about 3.8%, something like that. Your valuation is always going to be more expensive. But that one has gone with Interbay, and their rate's not horrible, So we're doing 80% loan to value, interest only. I think it's 4.29 on a 2-year fixed. So even, your Interbay, your Shawbrook, those sort of commercial lenders, they are getting a bit more competitive as well to compete with the specialist buy-to-let market, which is almost expanding a little bit, if you know what I mean, and getting a bit more specialist, if that makes sense.
And here's a question that you might not have the answer for, but when you do have a multi-unit freehold and it comes along to valuation day, let's say you're revaluing those 14 units, or the valuer who's valuing them for this type of lending, any feedback there in terms of calculations? Is it what the equivalent of a flat is worth times 14, or because it's not individual leases, it's a different value? Any feedback there?
Yeah, I always sort of try and simplify it a little bit. I would knock 10% off in my calculations if I was looking at comparables. Once again, no real pattern from valuers. For example, this purchase was £1 million. It's in Derby. The valuer valued it at 980,000. I don't know. still wait for the client. Like, it seems okay. So yeah, I always say if you look at your comparables. So if you've got 5 flats worth 100,000 each, you've got 500,000 if they are singularly sold flats. If it's a multi-unit freehold, probably say sort of 450. That 10% difference. And that sometimes means clients will go, well, I'll split them all off. But if you're thinking, separate utilities. Most multi-unit freeholds have separate utilities anyway. But if you have got to get the utilities drawn up, then you've got to get a separate management company for your leasehold. You've got to get the legals drawn up and stuff like that. It's not always worth it. I love multi-unit freeholds. It's one of my favourite things in terms of property investments. But yeah, some clients are adamant that they want to split the flats. And still, a multi-unit that's been split into 5 leasehold flats isn't quite as nice as one leasehold flat, is it? So people can still be disappointed once they've split them in terms of valuation.
Good stuff. Look, Craig, this has been great. I've learned a lot myself. I'm sure our listeners have learned a lot as well. So thank you for taking the time to come onto the episode.
No problem. Sorry if I've rambled on too much. I do get quite passionate about it sometimes.
Not at all. So I'd like to think that perhaps in a few months' time, as the market starts to change, we'll get you back on again if there's been any significant changes.
Yeah, definitely.
We'll see what the result of the MPC is today. By the time this episode comes out, we'll already know the result. But I think we both know where things are going, and the race to curb inflation effectively. Bank of England are going to do whatever they need to do. Yeah. But again, thanks again, and we look forward to speaking with you again soon.
No problem. Thanks, Amanda.
We hope you enjoyed today's episode, and if so, please hit subscribe and share with those who you think would enjoy it too. To get in touch with Paul and Amanda directly, please visit their website www.essentialpropertyoptions.co.uk for more information. We look forward to sharing with you on the next episode.